Hi, and welcome back to Unit 2 here. We're going to talk about depreciation and asset valuation in this section. The recommended reading there for in your textbook is listed on the screen. And I suggest that, in order to augment what we're going to talk about here, you go ahead and read those 10 pages of content there in the chapters. Let's get to what we have to talk about. First things first, when we hit upon depreciation, we're talking generally about machinery, buildings, anything that is helpful in the production of farm or agribusiness commodities. Basically, all of these assets and the utilization of them contributes to wear and tear and loss in value over time. So that pickup truck that you bought, as you use it over the years, it's not worth as much. And as you all would know that as you went to go to sell it, but the utilization of that for farm purpose or agribusiness purpose or business purpose of any kind is what we call depreciation. That's actually counted as a business expense due to its use directly affecting the production, whether it's meat, milk, or eggs. So you can subtract that or count that as a business expense each and every year. So the definition, book definition, is the annual loss in value due to use, wear, tear, age, or technical obsolescence. So, for example, some of you that have your, old Green Star systems or an old Ag Leader system, eventually some of those become obsolete, and you can, and then no longer have any value, and you can actually upgrade them and get to a newer system, which of course is a business expense, but also you get to depreciate the value of that in your expensing accounting records. So the reduction in annual profit as a business expense and loss of value in the asset, that's essentially you're trying to discount out of or expense to your farm the loss of that value. So what are the characteristics of a depreciable asset? They all have to have a useful life of greater than 1 year. So a pickup truck, a combine, a planter, breeding livestock counts as a depreciable asset because, cows or sows lose value the older that they get, generally speaking. But a market steer does not count as a depreciable asset. Its production life is counted as basically 1 year or less. So it has a determinable useful life, but not unlimited life. So therefore, land is not depreciable because we expect, number one, that it has basically an unlimited useful life. And number two, it should actually appreciate in value. So we utilize, again, these things utilize the depreciation and count that in our accounting records as a business expense. So here's some examples again: farm vehicles, machinery, equipment, buildings, livestock, even fences count as a depreciable asset. If you put in irrigation wells, those also count. But again, I mentioned land is not depreciable, but if you do improvements to the land, like building, putting a building on it, building a shop, or putting tile in or a fence, those in fact are depreciated. So we can calculate this mathematically, and it's the only true way to determine is appraisal or sale of that asset when we calculate these things out. But we're going to do some estimations just so you understand how depreciation works. Terms to know here. First is cost, and we're talking about price paid for the asset, including tax, delivery fee, installation, licensing, whatever, all related to putting that asset to use. Useful life then is the number of years the asset is expected to be used in the business. And we'll show you a chart here of what the business community looks at as useful life on farm business assets. Salvage value is the expected value of the asset at the end of its assigned useful life. So, for example, I believe pickup trucks are about a 5 or 7 year useful life. So what is that pickup truck worth at the end of its useful life? It's rarely zero, actually. But it may be if it's completely used up and has no value. So there should be a relationship between useful life and salvage value. The shorter the useful life, the higher the salvage value typically. Also, we're going to look at book value. So the asset's cost minus its accumulated depreciation, somewhere between the cost and the salvage value is where that lands. And it's not always the same as market value. Sometimes pieces of equipment are valued much higher than their cost. because there's not very many pieces out there, or occasionally that we get a flood on the market and there's not as many buyers, and so the value of that equipment drops because there's more of it sitting there. We can look at several methods of calculating depreciation. We're going to focus in on just a few here, but the method should select what you are depreciating. It's important that you do that appropriately. So we're going to really key in on the two most common methods. The first is what we call the straight line depreciation method, and I've put the equation here, but it's very easy and gives the same annual depreciation amount for each full year of the asset's use. So it's calculated by annual depreciation equals, so we take the cost minus the salvage value and divide it by the useful life, and that will give you the same depreciation each year. Okay, we'll be doing an assignment on Canvas and in class to kind of go through some example calculations. But if the useful life of that asset is 5 years, you would be then deducting as a business expense the same depreciated amount for each of those 5 years on that asset. Here's an example. Let's say we bought a $10,000 machine, doesn't matter what it is, and we know that it has a $2,000 salvage value and a 10-year useful life. So we take $10,000 minus $2,000 on the top side of the equation, 10 years in the bottom side of the equation, and that equals an $800 depreciated expense that we'll get to use over each of those 10 years, or as long as we have that asset in the fleet. Then we have the declining balance method, or also the double declining balance method, where the annual depreciation, or the book value at the beginning of the year, we multiply that times R, which is a constant or a percent value or rate it's used each year. And that declining method, the annual depreciation declines each year with this method. The double declining method takes 2 times that annual depreciation. So for example, we talk about pickup trucks a lot. Pickup trucks decline in value very, very quickly. So if we went out this afternoon and bought a new pickup truck, the moment that we drive it off the lot, it depreciates in value. If we drove it around the block, took it right back to the dealer, and wanted to trade it back in, they would definitely not give you the same amount that you just purchased it for 10 minutes earlier. It will have already accrued depreciation. Unfortunately, that's how it goes. And in the first few years, it declines in value greatly. Then that depreciation slows over time. What we mean by this in a depreciation and therefore accounting and business expense is we should capture as much of that depreciation as we can while we use that asset early on. So if that depreciated amount is $25,000 in the first year and $20,000 in the second year, we want to take all of that depreciation if we can, because it maximizes our business expense. So you can also use partial year depreciation, but we're not going to cover that if you only had an asset that you used for part of that 1 year. So what is the best? It depends upon the asset. So the method doesn't really change total depreciation over the useful life. Most of the time, whether you use straight line or double declining, you're going to end up with the same total amount of depreciation, but the depreciated amount does change. So there are some assets that are suitable for that declining or double declining method. Like I said, tractors, farm vehicles, pickup trucks especially, equipment, again, lose a lot of value quickly. And then that loss of that value tends to kind of level off. And then other assets like a cow tends to lose value at a much more level rate. So things that fit the straight line method, buildings and fences, like buildings, as long as you maintain upkeep on them, they lose value at a very even or linear rate going down. So what we utilize this stuff is for income tax depreciation. So again, it has to be done according to IRS rules. You can't be fudging the numbers here. But again, it's calculated from a beginning tax basis. And there's some guidelines here that are listed at the bottom of the slide that I won't spend time going into. You can read those in your textbook. But we're going to utilize this again in determining our income taxes because we can subtract these as business expenses. So here are the classes broken up into 3, 5, 7, 10, 15, or 20 year depreciable assets. So, for example, a 3-year depreciable asset is breeding livestock hogs. 5 years, cars, pickup trucks, breeding cattle, whether it's dairy or beef. Computers are actually a 5-year depreciable asset. Pickup trucks. 7 years is most farm machinery. So that field cultivator that you bought has a expected 7-year lifespan. Grain bins have an expected 7-year lifespan in terms of useful life. Now, we all know we have bins at home that have been standing much longer and in service still much longer than that 7 years. Just from an accounting perspective, they tend to not really have any value, or they've reached salvage value at that point in time. 10-year single-purpose ag structures. So you build a facility that only does one thing, like a milking parlor. Most of the time, that is that will either fall in that 10-year or even 20-year depreciable asset category. So it depends upon the piece of equipment that you're using, which depreciation approach that you're going to take. Again, when we talk about that AGRC system, you can read through that in your textbook. Depreciation of 100% in book value is 0 at the end of its useful class life. That's the only time that you would get to 0. So here's an example of recovery year, and breaks out by 3-year, 5-year, or 7-year class how much depreciation you may take on a specific asset. Just an example table here. So when we talk about economic versus tax depreciation, again, the economic depreciation is used to track the true value of a farm asset. Tax depreciation often results in 0 value when, economically the asset still has market value. So here's a good example. That grain bin that I just mentioned, it may be 15 years old at home on the farm. And, in terms of economically, it has actually, from a tax perspective, it has basically no value. Its depreciable useful life is exhausted by 2 times, actually. But you could sell that thing. It does actually have a little bit of value, potentially, if you could get somebody to come and buy it from you. So there's sometimes some differences in tax depreciation and economic depreciation. So sometimes it's hard to, that clouds a little bit the true profitability picture of a farm. That's where you get into market value versus cost value. So market value of an asset, when you put a value on something, is the current market price. So, for example, if you have grain stored in the bin at current market value, that you could sell those things in a relatively short period of time. That's market value. Also, there's cost value. So purchased items at their original cost. So, for example, land, cost you so many dollars per acre to buy. That was the cost at that point in time. Feed, what it cost you at that point in time, and it probably loses value over the time that it's stored. Okay, we also have farm production costs, and those are items produced on the farm valued at cost of the inputs to produce it. So grain, hay, and forages. So these things do not then include profit or opportunity cost. So that wraps up depreciation, and I want to ensure you that we're going to dive a little bit more deeper. I know this is just a very general video in terms of the things that we're going to be covering in class, and I hope that the assignments and activities that we do will much better demonstrate and enhance the lecture that we've recorded here. Thanks for tuning in. Look forward to seeing you soon.